So how does the Thinkorswim Analyze tab work? In this video, I'm going to walk you through this feature so you can use it as effectively as possible. Hey, how's it going? On this channel, you will learn the steps it takes to make a full-time income trading in the stock market. And today, we're talking about the Analyze tab in Thinkorswim. To start off with, if you don't know where the Analyze tab is, it's just going to be up here at the top and then Analyze. Now, I'm going to generally be looking at the Risk Profile tab in the Analyze tab. I don't really use a lot of these other tabs in here because I don't find them very useful for when you're analyzing your options positions. Now, diving into this, first off, you can link this to your charts or whatever you're trading. So if you're looking at, let's say, a chart of Apple, you can have this immediately pull up Apple. So actually, if you have current trades on in Apple too, and this is linked, you can just come into the Analyze tab here, look at Risk Profile, and it will show you every position you currently have on Apple and how that will pan out as the stock price changes. You will see those trades down here, and then you'll also see up here the graph showing you what will happen. Now, if you have no trades on right now and you want to just analyze something, all you have to do is go to Add Simulated Trades. You can't do this from the Trade tab. You can't add a trade from here. You need to go to Analyze and then Add Simulated Trades. And so that'll bring up the options chain. You can also buy stock doing this. You can buy, but stock is generally pretty basic. You know, if it goes up, you make money, and if it goes down, you lose money. Generally, this is for options. So what we're going to do here is we're just going to go to the monthly expiration, and I'm going to simulate buying a relatively close to a delta 70 call. And so I'm just going to buy single, and you'll see that adds down here, and then you go back to the risk profile. You don't have to like send order in or anything. Now, once you're back in the Analyze tab, this brings up your profit graph for that call. So that call, if we bought it at this exact price, and right now where the stock is currently trading, you can see we would be up no money. But as the stock would go up, this number here printing on the chart shows you how much money we would be up. And then in the opposite direction, it also shows you how much money you would go down. Down here, you can also adjust it if you wanted to look at, let's say, a 170 call instead, or a 165 call. We could do that as well. And then you can also just adjust the price you would essentially buy at. So maybe if you were trying to buy this call on a pullback and you wanted to buy it at $5 instead of the current value, you could do that as well. So at the top here, there are other options that you can do. You can include or exclude commissions, and you can also add other lines to the chart. So if we wanted to say, well, what does our option look like at expiration, and what is the value of it at expiration, we can also add that. And so this gray line down here shows us that at expiration, the value of our option will be over here on the bottom left, it will be negative 560. But currently, if the value went down there, it would be only negative 200. And so that is one of the nice things about buying and selling options without waiting for expiration, is that you won't lose as much money technically if the stock goes down to your max loss at expiration. You only lose about half of it. And of course, that is depending on how close you are to expiration. Because we are about 20 days away from expiration, we won't get close to max loss. But if we were still a couple days away from expiration and the stock went down to about 167, which is our max loss at expiration, we would be pretty close to max loss on our option as well. So keep in mind that this doesn't necessarily show you the value that you would get any time between now and the expiration of the stock. This shows you right now what the value would be at this current price. So over the next few days, something could change, or even based on other Greeks. So like if volatility increased, this graph could change, or if it went down, it could also change. One quick thing, if you don't like the color of your current lines, you can click over here and change the color of them. So just click on the date. I think clicking on the numbers doesn't actually work, and you can change the color of your lines so maybe you can see them a little better. So you'll notice these dotted lines in the background here and see these percentages up here. Now these are showing you probability percentages. So the probability that the stock will stay between here and here is about 50%, and the probability that the stock will go from here and here within this time frame is about 50%. And so include with that is this little price slice, and this shows you that, oh, if it got to this line, how much would the stock be up? And so that, I would believe, is linked with this one down here, and it would show you that you would be down $435. And then this one as well, you can move around, you would be up about 1,000. And then here's the at the money, or the current price of the stock one, and you can also move that as well. I don't find them super useful when trying to determine what I'm going to do with the trade. It's more of just interesting to be able to see how much you would potentially be down or up if maybe the stock went down a certain percent or up a certain percent. Another thing these lines do show you, though, is what the Greeks would be doing at these certain prices. So it shows you how the delta would change, how your gamma would change, and then theta and vega as well. Not only just the dollar value change in your option. Another awesome thing about this is it's really good for understanding how options work and with price changes. So we looked at the delta changing, and so I'm going to just take off the expiration line because it doesn't work very well for looking at the Greeks. It's more for looking at P&L. Now, so with delta, we can see that as the stock goes up, our option goes up in delta, and then as the stock goes down, our option goes down in delta. Now, looking at something like gamma, which shows the change of delta based on the price movement, you can see that it's not the same everywhere. So with the stock currently at about 171, our gamma will be the highest at about 167 area. And so with our option being at 167.5, as the stock goes up, our option gains value slower and slower. Now, it's not that much, but understanding that as the stock goes up, our option will gain value or gain delta slower and slower. Now, it's not that much slower, but it is decreasing in how much it gains every dollar value that the stock goes up. And then on the flip side, as the stock starts going down, the gamma increases, which then increases the rate at which your delta changes. And so as the stock goes down, you start losing money slower and slower. Because your delta is decreasing, you will start losing money slower and slower with the dollar change. Now, that sounds really confusing saying that, but as the stock starts going against you, your delta will start getting less and less, and because your delta is less, you will start losing money slower and slower. So in this sense, the gamma is actually in your favor for when the stock goes against you, because you already have a high delta call. As the stock goes up, you're getting just about as much money as you can already to begin with, and then as the stock starts going against you, this is in your favor, making your call decrease in money slower and slower for a certain amount of time. Now, it doesn't mean you're going to not lose any money. Of course, your calls are still going to go down, but just understanding that the gamma is in your favor, and so the hit might not be as bad if you were using a different delta call. Now, another big one to really look at and really understand with options is theta. And as you can look at this graph, it's kind of the flip of gamma, but theta is always going to be negative with these calls or with buying options in general, because your option always has that time value or that theta decay on it. You can see here theta peaks at where our delta 70 call is, and the call that we're buying. Now, that might seem counterintuitive that, well, why are we wanting to buy the call that has the most theta, right? Well, it's more about the ratio of theta to how much you actually have. So if we buy another call quickly, if we look at the, let's say an out of the money call, right? So a 180 call. So we add that, go back to our risk, and then we want to minus the 170. So we want to look at this real quick. Now, our 180 call currently has a theta of about $4 a day. So this call is losing about $4 a day. As the stock goes up, it'll gain value, and it will peak theta about where at the money is, and that's, because at the money calls always have the most theta, but it's more about the percentage. So this call is losing about $4 a day, but it's only valued at $64. So that is a large percentage of the value of that option decreasing every day. And on the flip side, if we look at the in the money call, it is currently valued at about $560. Currently, right now, it's losing about $7.50 a day. That is a lot smaller number on a $560 contract. It's losing very little money that you really won't notice it for a while compared to the out of the money option. That 180 call, you're going to notice that theta ticking away every day, and you're going to need the stock to move in your favor very quickly for you to just keep up with break even or even flip a profit. Now with this 170 call, we don't need the stock to really move for a while because that theta isn't really eating away as much money as us. Yes, it's still eating away more money in the end than this $64 call, but if the stock moves up $1, because it's a delta 70 call, we're gonna make $70. This out of the money call is probably a delta 20 or delta 30, which is only going to make $20 or $30. It's going to have to make that every 4 or 5 days just to keep break even. And so this is why understanding that out of the money options are very hard to become profitable if the stock doesn't move in your direction very quickly. That is why buying more in the money options is a lot safer, because it allows you to have that theta decay not eating away as much as your option, but also having that larger delta. So once the move does happen, you will be making more money. And yes, there is the argument that, well, with a higher delta call, you are risking more money. But as you start setting up trades and cutting losses at certain prices, in the long run, the higher delta calls will actually be more profitable and more consistently profitable than the out of the money options. Now the other two on here are Vega and Rho. This shows you that just Vega is the highest with at the money. So at the money calls, as volatility changes, they will feel the biggest change. Because if this call is at the money, this current value actually would be trading at 165, which is about where this is peaking out. The same with the Theta and this Vega here. Sorry if that was a little confusing before. Now the real beauty of the Analyze tab is if you're learning about options and starting to dive into option spreads and iron condors and all those other different strategies, this is a great way to visualize how those work and how those perform. So we're just going to start off with a basic put credit spread. We're just going to sell an at the money put credit spread. So I'm going to right click over here, sell trade, and do sell vertical. Now that's going to put the trade down here, and then we can go back to the risk profile. And again, it looks all super wonky. I just want to minus the trades I had off before. And over here, I could actually exit out on them and just take them off completely. We're just going to go to PL open to start off with. And we're going to look at also what the value is at expiration, because sometimes you hold spreads a little bit closer to expiration, and it's good to visualize the spread. We're selling the 170 put and buying the 167 put as protection. So at expiration, we will be up $100 if it's above 170, and then at expiration, if we're below or 167.5 or at 167.5, we will be down $152. But in the meantime, between now and then, we can see that as the stock goes up, we start to gain value, and then as it goes down, we start to lose value. And so this is another pretty easy way to actually just buy stock on leverage. You can see that as the stock goes up, we go up in money, and then as the stock goes down, we go down in money. And it's pretty linear for the first $5 in each direction about. And so this is a good way to get long or short a stock with pretty small dollar value required. This trade would only cost $152 to put on. And you would probably, generally with spreads, I like to shoot for, you never want to shoot for 100%. You want to, at the most, go for 80. And sometimes people say 50% is great. And depending on what you want to do, you could even do less. But you can see here the 50% of max profit would be pretty good, because the stock going up about $5 is That's a pretty big move, especially for Apple. Once you get above that price, it starts to taper off, with 175 getting you about $40 to $50, and then the next $5 only getting you about $25. So you want to try and do, max risk, max reward kind of with these things. You definitely want to get out when you're kind of hitting that peak or inflection point of the graph, changing from, making you a lot of money to starting to dwindle off and not making as much as it goes up. Now, looking at the theta of these is actually kind of interesting. So because spreads are really nice for capturing a little bit of profit, and then maybe if a stock just sits there, you still make money because your theta is actually positive as it goes up. Now, of course, if the stock is going against you, you do eventually hit negative theta. But if the stock did go up here, you would be making positive theta, with it kind of peaking up here about $6 above where we are, and then also down on the flip side, peaking down there as well. Now, I don't know if the system's just having weird issues with this showing up right here, but the theta should kind of taper back off like this. And then you can also just look at these other metrics, and you can see that as you get to different prices with them, Vega will increase or decrease, and then also Gamma. Now, Gamma with these spreads actually kind of flips. It's kind of against you with spreads. As your spread becomes more profitable and profitable, your Gamma is going higher and higher. And so that's why initially I said, you're going to want to cut your trade really about the 167 point. And you can see that's where the Gamma gets the most. And so that's where it kind of peaks off, and your delta kind of caps out there, and you're not making as much money as you were before. And so your risk to reward there isn't as good as you necessarily want. That's really why you kind of want to take profits when you hit that 50% or more profit, because you start to not gain as much as you had before, and then your risk on the trade is a lot more. Once you get to positive $50 in this trade, if we go back to the PL open, if we were up about $50, well, our max loss was $150 to begin with, but we've already made $50. So then we would be essentially risking $200 because we've already made $50 to get that last $50. So you're risking $200 to make 50 compared to 150 to make 100 before. And so your odds aren't as good anymore as well for the risk reward. And you're also just not making as much money as you were before as the stock goes up, just based on how options work. Now, to take a quick look at another trade, we can look at a Iron Condor. Now, so here's the Iron Condor all set up. And so you can see at expiration, if it expires between 165 and 175, we will make about $187. And then if it expires at max loss at 160 or lower, or 180 or higher, we will lose $300. But currently, you can see essentially wherever the stock moves, we actually lose money. And so that's definitely a weird thing about Iron Condors, is they need time, because Iron Condors are all about just having the stock move sideways and capturing theta as the stock decays and time goes on. Right away, the position really actually won't make any money. If the stock goes up from here, we lose money, and if it goes down, we make a tiny bit of money, but then it starts to lose money again as it goes further and further down. And so definitely when you're buying Iron Condors, be aware that right away, and even for maybe the first half of your Iron Condor's life, it won't make that much money. These are very slow strategies, and you have to be very patient to allow theta to kick in. Now, if we actually want to look at the theta of this Iron Condor, we can look and see that, as expected, if it's right in the center of our Condor, between our strike prices of 175 and 165, at pretty much at 170, the theta will be the highest. And so this is that area where we want the Iron Condor to sit. It's best if it sits between that 168-ish and 171.5-ish range, because the theta will be the highest there. And then you can see as it goes all the way out here, even when it's at our put that we bought as protection, or our call as we bought protection, our theta will still be positive. Now, that doesn't mean we're going to necessarily be profitable come expiration if it stays at that price, but you can still have the stock swing out here and all the way down here as well and still be decaying in your favor, and especially if it swung down here and then came back to the center here where you would be hitting that max profit still. And so one thing to understand that I can't illustrate very well on here is if we actually go back to the PL open, as the option decays in time, you can actually add these lines to increase time. So let's just add one. So as the time moves forwards, this will be more of what our graph looks like. And then continuing closer and closer to expiration, the delta will change, or the profit, sorry, will change more and more in our value. So if it's at 170 further and further down the road, you can see that we'll actually be up money. So even if it swings down here for, a few days or even a week or two, but eventually comes back into this area, we will be much more profitable than we were to begin with. So these are essentially just weeks out. So this is the current date is the gray value, or the teal value, sorry, and then the gray value is 7 days from now, and then the pink value is another 7 days on top of that. So you can see as 2 weeks go by, this will get more and more profitable, and then we can actually even add another day, another time, and you can see that as this gets closer and closer to expiration, with that 4th week actually being expiration or past expiration, so that line doesn't actually print anything, but this gets closer and closer to actually looking like the expiration value or the expiration assignment value of what an iron condor looks like. Now I can't put both of those on this graph sadly, but if you visualize this and then I go back to this, you can see that it looks pretty similar to that, because that last one would have been probably the day before expiration, because today's Thursday and this option would be expiring on the Friday the next day. Now, I definitely didn't go over everything that the Analyze tab has to offer, and there are a ton of different option contracts that you can look at and play with this platform. Now, definitely make sure to subscribe to the channel if you like this kind of content, and if you have any questions, don't hesitate to ask them in the comments below.